Good afternoon or good morning, depending on where you are. Thanks for joining us. I'm Ken Kirschenbaum. Today we have a exciting webinar presented by Jim Wooster. And as you probably know, he's with, let's see, what is the name of that company? Alarm Financial Services.
There we
go. That Alarm Financial Services is the lending end of his operation. And the Woosters are known for being in the lending business, where they will finance your accounts, acquisition of accounts, and in connection with his financing business, Jim was doing an awful lot of due diligence for himself, and so he contacted me and he said, you know what? He came up with the idea that since he's been doing this due diligence for himself, he thought he would start to offer that service to the alarm industry. And believe me, they need it. And so he knows what to look for in a deal. And he was self-interested, of course, because he was financing these deals. So when he did his due diligence, he was making sure that his investment as lender in the transaction was less risky. He had to reduce his risks, let's put it that way. And so now he offers his service directly to the alarm companies to perform their due diligence. So due diligence means a lot to different people. Every industry has their own way of conducting it. Different issues are important to different industries. The alarm industry, of course, our primary asset are the alarm accounts, and to review those accounts and make a decision as to whether or not they're worth the price that a buyer is paying, whether they're worth the price that a seller is asking, and what issues need to be considered when making that decision. It can be an arduous process. Not every deal is 150 accounts. Some deals are thousands of accounts. And I'll give my lawyer input at the moment before Jim gets started. You have 2 times that you can perform this due diligence. One is before the deal closes, and that's when you want it done, before the deal closes, because the other time to do it is after the deal closes. And if it's done after the deal closes, that is in preparation of litigation. So if your due diligence is done before the closing, it's in preparation of the closing to confirm the price is right. If it's done after the closing, it's to prepare for litigation. It's to figure out, how do we shake out these accounts? How do we find representations and warranties made by the seller that are not accurate? Well, Mr. Seller, we went through your 2,000 accounts and we found that you didn't have contracts for 50 of them or 100 of them, or you altered contracts on another 200, or you told us you were getting $50 a month and it turns out you're only getting $45 a month, or you told us you didn't have radios and it turns out you got a bunch of radios, or you told us that you didn't have any 3G radios and it turns out you have hundreds of 3G radios. Well, guess what, Mr. Seller? We're not paying, and if you don't send us a check back, we're going to come after you for what we did pay you already. Well, you want to have that conversation before you close so that you don't close unless you're so desperate as a seller that you have to anyway. But somebody has to go through all of this stuff. That's what Jim is going to do for you. That's what his new service is all about. And I'm going to let him describe it to you on his own, but I happen to know his range of pricing and things like that, and the things that he's going to be doing. and they're right on target. He's got my full endorsement. He knows what he's doing. He's not doing things that are just nonsensical in the evaluation. He doesn't need to study. In my opinion, there are things that are totally unnecessary. A potential buyer of your accounts, if he's buying your assets, he doesn't need to know what profit sharing plans you have, what you pay your employees, he may want to take over your employees for sure. So yes, he may want to know what you're paying your employees. But some of these potential buyers think that they are doing a stock purchase agreement, which is different than an asset purchase agreement. If there's a stock purchase agreement, they are stepping into your shoes, your ownership of that operation, and they are stuck with whatever it is you're doing in that operation. But an asset purchase, they're just buying your assets and they're on their way. And it's a completely different due diligence operation. So with no further ado, Jim Wooster doesn't need much of an introduction. He's well known in the industry. And Jim, I'm going to turn over presentation to you right now, right away. Right click. Okay.
All right.
Make presenter. 1 second. You're now the presenter, and your screen should come up, hopefully.
Let's see.
There you go. You're in, man. Thanks, everybody. Enjoy the webinar. I'll be here to harass Jim as he presents.
Okay. There's the welcome screen. You can see that now. I assume so. All right. Well, we'll get going.
Yeah, you're good to go. You're good to go.
All right, we're good to go. Thanks, Ken. Appreciate that introduction, and you set up my presentation pretty well. I think now that took care of about a third of my slides, so we're going to be through this pretty quickly. But I do have a few slides I want to run through this morning, and then I'm hoping, Ken, you and I will get into a little discussion on some of the points, and then hopefully open things up to Q&A as well. So first of all, thank you very much for having me. Between your newsletter and these webinar series, this is quite an awesome service that you are providing to the industry. So I don't know if you set out with all of this in mind years ago when you started doing these newsletters, but this has grown into quite a great forum for the industry. So thank you for doing that. Just to start off, a little background on Alarm Financial Services, and Ken kind of alluded to this a little bit. We provide financing strictly within the alarm industry, security, fire, PERS companies throughout the United States. And we do that primarily through loans that range anywhere from $150,000 upwards of $1.5 million. And we are the oldest funding company in the industry, and we're former operating alarm company owners ourselves. So this is by way of perspective and background. We'd like to say that we are alarm people that got into the finance industry rather than finance people that got into the alarm industry. So today's webinar is about due diligence. So what is due diligence? And in its simplest sense, it's the research a company performs before engaging in a financial transaction. A little bit more specific definition, it's a comprehensive appraisal of a business undertaken by a prospective buyer, especially to establish its assets and liabilities and evaluate its commercial potential. So just as Ken laid it out. And in our industry, where due diligence fits in is typically after a letter of intent has been presented and accepted, based on some preliminary information that a buyer has obtained, enough to feel confident about presenting a price and certain terms and conditions. Then you jump into the due diligence to really validate and verify that information, as well as just to obtain a lot of operational information that's going to be needed to transition the accounts from seller to buyer. And then the due diligence culminates with the asset purchase agreement, which formalizes the transaction. So why did we get into this? And Ken really did hit on this pretty clearly. We started out as an operating company buying other alarm companies, so we were performing due diligence on our own behalf. Then we started buying accounts from companies all over the country when we migrated into becoming an aggregator of alarm accounts. Then we started doing loans. And so as part of the due diligence, as part of the loan process, as Ken mentioned, we needed to qualify the assets that the borrower had to see how much we could lend them or how risky that loan was going to be. So again, we were performing due diligence on our own behalf. And out of that, doing loans to buyers who would use our money to complete an acquisition, and us performing that due diligence, we started getting hired from the buyers, even if they didn't necessarily need our financing. Maybe they had another credit facility, maybe they were doing the deal with cash, maybe they were doing seller financing. So they would hire us to perform the due diligence on their behalf, either if they didn't feel that they had the experience that we had in performing due diligence, or they thought a better use of their time was just to sort of focus on their core business and hire us for what we were an expert at. So what we did in performing all these due diligences is, we would realize and we would see time and time again that the sellers were just leaving a lot on the table, right? They were coming into these transactions not necessarily prepared, having a lot of accounts that would be later deemed ineligible, RMR that would be deemed ineligible, accounts that would be thrown out of the deal. And so we really just thought, well, what if the seller had done this themselves in advance? They'd be in such a much better position to present their company, present their assets to a buyer and get a fair value for them. So we just recently now have started working on behalf of sellers to sort of do a little self due diligence, not 30 days before they want to close, but with enough of a runway that they can make significant improvements and corrections and enhancements well in advance of a sale. So what comprises due diligence? When we perform due diligence for buyers, we perform due diligence on our own behalf as a lender. We have 8 distinct reporting areas that we present to buyers. And I'm going to list these out here. I'm not going to go through them in a lot of detail at this moment. We can sort of revisit this later in the presentation, or people can chime in, I think, with questions later on. And Ken, you and I can drill down on some of these as well. We start with lien searches, UCC searches. We do RMR verification, as Ken mentioned, to verify that what the seller says they have is what they actually have. We look at customer pay histories. We look at AR aging. Of course, we look at attrition. We look at the contracts. We perform quality assurance phone. We look at calls to customers. We look at central station signal information. We look at the information at the central station, contract, if it's a third-party central station, to see that it's consistent with what's on the or what's in the billing system. We look at what the costs are related to monitoring, whether it be direct central station, and we look at the financials of the company. And as Ken mentioned, we're not going to get in necessarily to everything related to the financial statements, but there's certainly items that we're going to want to focus on that are pertinent to a buyer. So, what are the biggest deficiencies? And perhaps not surprisingly to many of you in the audience, I'm sure not surprisingly to you, Ken, contracts are almost always where we see the biggest deficiencies. Missing contracts, contracts with crossouts over key sections, contracts that haven't been updated when the customer has moved, contracts that don't have proper or industry accepted terms and conditions, contracts that are not signed. So, just to start with contracts alone, a prospective seller can do themselves such a great service by looking at their contracts well in advance of a sale. And even if you were not contemplating a sale right now, having proper contracts in terms of reducing your liability exposure, et cetera, is essential. It's like a non-starter. So Ken, I don't know if you want to chime in on what your experience in M&A and seeing contract deficiencies. But this is just a partial list and goes on and on. Maybe you think I've missed something here, but I'd certainly like your kind of perspective on this item as well.
Well, I've been saying for a very, very long time, over and over again, as a matter of fact, in many of my articles that come out on a daily basis, that in my opinion, the contracts are what you are in fact selling. When you go to that closing, think about it. You're going to a closing and you've got a briefcase, or you got in many cases you've got a couple of boxes, and you're walking into a closing. Well, what do you think's in the box? It's not your car, it's not your bank accounts, it's not your website or whatever you write. It's your contracts. That's what you're bringing with you, because that's what you're selling. It's very simple. When we do very quick valuations, which you can get by going on my website and go to what's my alarm company worth, you can get a very quick valuation. What do you think we look at? It's very important to consider what your contracts are. When we say what are you going to get for my money? What for my accounts? I'd almost get a call on a daily basis. What's the going rate? What's the multiple? I got asked that today. What's the multiple? Well, what's the multiple? It could be as low as 12. It could be as high as 44. Let's say. Yes. Is there 60? Maybe. Is there 10? Maybe. What is it based on? Well, it's based on, it starts with, here's my contract. Because that's the first question. Do you have contracts? That's the first question. Okay? Then it gets a little more. Now, who are they with? Are they with residential? Or are they commercial? Are they intrusion? Or are they fire?
So one of the things that we encounter a lot is that there can be a perception by alarm company owners. There can be a perception by alarm company owners that the purpose of a contract is to enforce a payment term.
Yeah, well, that's wrong. These contracts, for the most part, buyers aren't really looking at whether they can enforce the contract. And I'll tell you a good reason why buyers aren't focused on that as the number one issue, because they're all getting a guarantee. So if they can't collect on their accounts, that's not really their problem, at least for the first year or during the guarantee period. What they're really concerned about is liability, because a buyer can buy your accounts. Maybe the buyer's got 10,000 accounts. Maybe you've only got 100 accounts that he's buying. That one of those 100 accounts suffers a catastrophic loss. It puts that buyer entire business in jeopardy at this point. That's what they're concerned about.
Right. So the buyer doesn't want to take on that liability, right? So other deficiencies that we come across when we're performing due diligence on our own behalf or on behalf of a buyer, AR aging, right? The accounts that are over 60 days past due, over 90 days past due, depending on how that letter of intent is negotiated, they're going to be accounts that are going to be thrown out of the deal, right? If they're over 90, they're not eligible. They will not be part of the purchase. So AR aging is certainly an area that, with working on it ahead of time can be, in the lead up to a sale, can be improved. And again, you don't even have to be leading up to a sale. You want to be on top of your AR aging anyway, just as a good business practice. And certainly attrition. And I think from an attrition standpoint, it really is interesting. I don't know if are many more meaningful sort of metrics that we have in our industry than attrition, and yet we rarely see it measured by, at least in this segment of the alarm industry that we serve, which is sort of the small to medium-sized dealer. We rarely see it measured. We almost never see it measured accurately. And yet it's one of the most important metrics in our industry. We do find, though, that the companies that do measure it, perhaps not just coincidentally, seem to have lower attrition than the companies that don't measure it, right? They become aware of it, they focus in on what reasons for attrition might be on the rise, and they address that. So attrition is certainly another deficiency that we see. We look at the monitoring in terms of late to test signals, late to test messaging, signal problems. We look at accounts they haven't signaled for 2 years, something like that. And so again, these are things that could be addressed in advance. Obsolete technology is another area, and we don't have to look any further than the 3G sunset that's occurring right now. And there was a point several months ago when buyers, if the seller had 3G radios, they would be discounting them in the sale, maybe $250, $300 per 3G account that they were going to acquire, because they were going to have to incur the cost themselves of going out there and upgrading that technology. And now that we're in September 2022, these 3Gs are they're not even being discounted, they're just being left out of the deal, because the buyers are looking at them as it's too late, with what time is left, that they're focusing perhaps on still finishing their own. So now we're seeing these accounts be completely left out of deals. So again, some other areas that I would look at, maybe not necessarily as deficiencies, but opportunities to enhance in anticipation of selling. Turning more revenue streams into RMR. And one of the quickest places to find that would be something like fire test and inspection. So Ken, I'm sure you've been in transactions where if the fire test inspection is treated as RMR, insofar as it's part of the recurring revenue contract, that it's billed along with the recurring revenue for monitoring, et cetera, that RMR from those test inspections gets treated with a multiple for the purposes of the purchase price, as opposed to if it's done annually and billed on a time and materials basis upon performing it, that might get left out of the RMR calculation. So we see that a lot, and the test inspection is just one opportunity to turn a revenue stream into RMR. Certainly through leases is another. We work with a lot of companies where we provide them lines of credit, and so that allows them to cover the initial costs of installation, equipment, sales commission, et cetera. And so they don't need to get their complete costs covered by the customer at closing. They can draw down on a line of credit, cover some of those costs, and maybe they have a 16 or 18-month break even because they'll have a little bit higher RMR, and then they'll have that higher RMR perpetually, right? So it's more cash flow, more profit on an ongoing basis, and then when they sell that higher RMR. So that's another way, and I could certainly take that conversation offline with any dealers that want to talk about how to create kind of their own leasing program to increase RMR. So another area where we see a lot of opportunities to enhance are with low RMR accounts, right? They haven't done a price raise in years, if sometimes ever. So we go in, we sort of identify, how many accounts are at $24.99 or how many are at $19.99, and how long since the last time you raised somebody. And here's this segment of your account base that could be eligible for an increase. And again, even if you never sell, or even if you don't sell for years, you'll be the beneficiary of those, of taking a look at that. And then you get the second benefit later on when you sell those. A lot of times sellers get frustrated in the acquisition process because they feel like the rest of the business is getting ignored, right? The buyer is just so focused on RMR that there's all these other profit centers in the company, and why aren't they getting some value for those profit centers? And my opinion on this is that the onus is on the seller to document and report and demonstrate to a potential buyer what profit and benefits they're going to inherit. The buyer doesn't need the seller to tell them how much profit they're going to make off of the RMR accounts. The buyer already knows that. Buyer has their own. The buyer can figure it out. The buyer knows what their sell costs are going to be and their central station costs are going to be. So, but the buyer doesn't know how many customer referrals you're getting for camera jobs or access jobs or gate jobs or whatever else. And so if you can demonstrate that as a seller, what profit streams the buyer is going to inherit, then you should get compensated for that. But again, you can't wait for the buyer to figure that out and price it. You have to come to the table already knowing what those other revenue streams, that they have value, and being able to show what kind of value they have.
I want to add something, Jim, if it's okay, on that topic. So you have a lot of sellers that will say, listen, we get a lot of per call revenue on repair service. We get a lot of fire alarm inspection revenue on a per call basis. We make a lot of money on our sales. So while we may have a RMR of $10,000 a month, we focus our business on installation, and we make a lot of money on installation every month and over the years, and we need to be compensated for that. Well, so here's the problem with that, though. More often than not, the owner of that company, for some reason, hasn't factored in his or her own importance to the business. A buyer is not planning, usually, on relying on the seller's principal, to remain with the company and continue to perform as he has in the buildup of that business. So a buyer, what he's looking at is the tangible asset that he's buying, which is the RMR contracts. So sellers are very often disappointed with when they sure, they've made a great living, they've built up a great company, and they've made a lot of money, and they've done it because they have all this per call business, so they have it because they've priced their sales and installations in a very profitable way. But that kind of information is not as significant to a buyer, and that asset is not as significant to a buyer as you may think. Where is it really reflected? How does it really show up on a LOI, letter of intent, or in the calculations in the mind of a buyer? Well, I think, and I'd be curious whether Jim agrees with this, but I think it's the intuitive factor of what am I willing to pay for the accounts? Am I willing to pay 30 times, or am I willing to pay 44 times? Why is there such a spread? From a dollar standpoint, you would think I don't know whether this is a derogatory term or not, Jim, and I don't mean it toward Jews. From a bean counter standpoint, what's the difference? We're just looking at numbers. You're buying revenue, and you're hoping it stays constant over this period of time. It's like banks that buy notes or buy bad debt or whatever you're buying. There's a dollar amount that you well here. Why is one company getting 30 times and another company getting 44 times? Well, because intuitively a buyer is saying this entire operation is worth more. This particular account is worth more. Maybe you've got an account that's being monitored and you've got a lot of per call work that you see. You won't see a calculation that includes that per call work, even on an EBITDA basis, in my opinion. But what you will see is a buyer willing to pay 40 times plus for that particular account, as opposed to saying, 30 times. That's all I'm willing to pay for that particular account, because they know that there's an enhanced value in that monitoring account. That's what I think.
No, I think I look at it very similarly. And when we are doing loans, or when companies have hired us to perform due diligence, they'll often talk to us about how to price this deal, right? What multiple do we think they should offer? And what I always tell them is you have to look at it in two categories. Number one is just look at the accounts on a standalone basis and what are the cash flow from those accounts, right? So what do I need to know? I need to know what the RMR is, I need to know what the costs are, and I need to know what the attrition rate is, right? And then I can figure out what the cash flow is going to be just on that stream of accounts, and as if that's the only thing in the world that exists. And that points you in one direction in terms of a multiple. But where you end up on that spectrum, Ken, that you're talking about, is it 30 or is it 40, is because of the second component to the pricing. And that is, what else am I going to get along with this acquisition, right? What else comes with it? Do I have the opportunity to sell other services to these customers that they don't have? Does this customer base generate a ton of referrals, et cetera? But again, the onus is got to be on the seller to demonstrate to a buyer, hey, here's why you should pay me at the higher end of this multiple spectrum, because you're going to get X, Y, and Z. And again, that's why I use the word in this bullet point, inherit, right? It's not what the owner brings to the table that is going to go away when the owner sells and retires, right? It's not that. It's what's going to be left over that I, as a buyer, am going to walk into. But again, the buyer's not going to just sort of proactively go and try to find a reason to bring the multiple up. It's going to be up to the seller to try to show all these other revenue and profit streams that the buyer is going to walk into. And another thing, I mean, I'll just move to the next bullet that has become hugely important these days, is the human assets, right? Now we're working with buyers. Before, it sort of felt like they really just were solely focused on the accounts, and they didn't want to necessarily take on employees. They just wanted to fold the accounts into their operation. But now it seems like every deal that we're involved in, the buyer is asking, are there personnel that come along with this? Do we have the opportunity to hire the employees? It's completely flipped on its head.
I just want to concur with that, Jim, because it's funny, because I used to say over and over again, well, the first question is, what contracts do you have and everything. And I have to admit, lately, how many techs do they have? That's what I'm hearing.
Yeah, 100%. So if the seller is doing a good job of laying that out to the buyer and saying, here are the technicians, here's their experience, here's et cetera, then that's going to help when we're talking about that multiple range and where do you end up. The more positives like that you as a seller can present, the higher you're going to end up on the range. So and obviously I don't see that being a short-term issue. This feels like that's going to go on for a little while. So obviously it's important for buyers to perform due diligence when they're making an acquisition. It's essential that they identify the risks, minimize that risk. It's a lot of money that's being put out there, and so they want to make sure that they know what they're getting. But it's also important from the seller side, right? So we call this pre-sale due diligence, and to identify the issues so that you, as the seller, your shortfalls, the warts, you can address these things before. You don't want the buyer bringing these things to your attention. You want to know about them, right? And obviously this translates into getting a fair price and maximizing the value for your company. But also, we know what the buyer's looking for, so we can help package this information in a way that the buyer wants to see it, that we anticipate what their questions are. We know what their questions are. We're the ones that help the buyers figure out what questions to ask. So, you're going to present it in a manner of that want to receive it. And so I think that also lends a little bit of credibility, not to sort of, toot our horn too much here, but I think if a buyer is going to see that a lot of the information has been prepared by a company like ours, they're going to, I think, put a little bit of credence in that information, I hope. And also, you want a smooth transition, right? These are your customers that you have had for years or decades. And so, as you're handing them off to a buyer, you want that process to go smoothly. Monetarily, you probably are going to have a holdback that is dependent on that going smoothly, but you know these people, right? And you want them to be have a good handoff. So having all the information about your company that's delivered to a buyer so that they can transition those accounts over is really important. And again, as I've said a couple times, all these issues are ones to tackle even if you don't see a sale for years down the road. You're going to benefit from that work right now in terms of efficiencies in your organization, reduced liability in your organization, more profit in your organization. And then when you do sell, you'll benefit from that again. So, Ken, again, thanks for this forum and this opportunity to talk to all your subscribers and viewers. And so I'm hoping we can talk a little bit more about some of the items I touched on here, and I'm hoping we can get some input from the audience as well.
Whoa. I took a quick, Jim, I took
Yes.
a quick call from Italy. Sorry. I didn't hear whether you asked me anything.
Oh, what I said is the first thing everybody needs to do is contact you and have them do a review of their contracts. That's what I said.
Well, that's fine. What they need to do is upgrade their contracts right now. Where operators are standing by. Upgrade your contract. You can't go wrong with upgraded contracts. Simple as that. And by the way, I wanted to pop in and say something about the due diligence process. You know, a seller really needs to be very leery. I said this earlier. When a buyer does not do due diligence, the right due diligence, because I approach a lot of things and a lot of these deals from a litigation perspective. So the question is, with me, not when we do a deal, not where we're going, what bar we're going to celebrate this great transaction, but what can go wrong? When is the fan gonna start turning, and we're gonna have a problem here, and what problems can we have? And we know what they are. They're representations and warranties that are requested by many of these buyers are in many respects unreasonable. Okay, so you might have and you need experienced counsel to guide you through these acquisitions and these deals. If you don't have that, you run the risk of having disputes after your deal closes, and you don't want that. Most sellers are interested in heading out somewhere else than having to be involved in disputes over their transaction. So you want to make sure that all the right questions are asked. And look, I think Jim's service it's available to buyers, of course. Buyers can say, Jim, we're interested in buying this company. We've given them an LOI, and we now have a due diligence process, a due diligence period. We want you to perform the due diligence. That's what I think Jim is offering that to buyers. He's also offering to sellers the opportunity to come in and say, you engage me, let's get your business up to snuff, so that a reasonable buyer performing due diligence is not going to surprise you. I should say that we'll have all the ducks in order, but Jim doing his review isn't necessarily going to get all the ducks in order. What he's going to do is tell you how deficient you are in whatever areas you might be deficient. And I don't need to approach it in a negative way. He may tell you that you're perfect in every way, in which event you should be asking and should be entitled to that bigger range for multiple. Or maybe he can figure out why you should be getting something even more than that. Than just the multiple. But you need Jim, not someone like him, because I don't know if there's anybody like him. I just don't know. Maybe there might be other people doing due diligence. I really don't know. Okay, I don't do due diligence. I don't have the patience for it. Okay, I do the litigation and I do the transaction, and that's what I do. We have some questions. Why don't we start to look at them? Okay.
All right.
Let's look at the bottom ones first. I think they trying to figure out which ones came in first. Okay, here these came in. Okay, bravo, Jim. Points were right on target. do pre-due diligence on your own company and do a refresh yearly. That's good advice, and that's bringing someone like Jim in to do a review of your operation. You know, unless you've got the patience and the time and the knowledge to do it, you're much better off having a professional come in and do it for you. It's like an annual physical that you're taking, okay? And some of you guys need it. If you're like me, you need more than an annual physical. You need to go monthly.
So this brings up a kind of a natural question about the cost. And so I'll just, in anticipating that somebody might ask that, I'll just jump into it. You know, we're finding these engagements running anywhere from, let's just say, $7,000 to $14,000. And so just to kind of put that in perspective, in terms of the fact that what we do can pay for itself. You know, if we found $500 of RMR that would have been thrown out of a deal or would have been considered ineligible, and even at only a 30 multiple, right? That's a $15,000 savings right there. And $500 of RMR, if you had a company that had 20,000 total RMR, 500 is only 2.5% of that, right? So can we find 2.5% of the accounts where that would have been considered ineligible or thrown out of a deal? If you have $500 in RMR that we're finding at $13 an average, that's 14 accounts. So this service kind of pays for itself. Can we go into a company that's got 20,000 in RMR and find 14 accounts that would have been thrown out of the deal had we not jumped in there? So just to kind of put that cost in perspective.
You know, there's something else that you need to say along with that, interestingly enough, and it's the seller rather, who's sitting by going, hey, why should I spend any money on looking into due diligence? That's the buyer's headache. I'm not calling Jim. I'll wait and see when a buyer comes in and let him figure things out. Well, guess what? You're kidding yourself, because again, I don't know how big the company is, but and maybe this is in proportion anyway. But what I've seen is, particularly on the big deals, the buyers come in and they torture the sellers during the due diligence process. A seller, you think you're not going to be involved in the buyer's due diligence? Well, you better think again, because they're going to be making you do most of the work. And it'd be a very good idea to have it done in advance for two reasons. One, it'll be done and you'll have it. And number two, you could turn around and tell, and this is even more important, you could turn around and tell that prospective buyer and whoever's doing their due diligence, listen, this is what we have for you. We're not giving you 10 other items that you've asked for, because it's a bunch of crap. This is what we know you need, and we're giving it to you. And that's it. And guess what? The buyer wants more. It'll be up to you whether you want to allow them to, how much you want them to torture you before, in my opinion, that deal dies. Okay? But that brings another point, which I didn't go through all the questions yet, but when is a deal stale? When does a deal go from, hello, I'd like to buy your company, I'm really thinking, I love it, blah, 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 and we'll send you over a letter of intent. Okay, so within a week, you got a letter of intent. Now what? What's the rest of that deal? When does that process turn into nonsense? Okay, I'm not talking about selling ADT. Okay, that's not what we're selling here. I'm talking about the average deal that we see. Jim, how long should it take?
I mean, it shouldn't take, these deals, the guidance that we give is we say, listen, we need, 4 weeks to do this, but that's on our part, right? the delays come not from the performing of the due diligence per se, it's in obtaining the information in order to perform the due diligence, right? Getting the reports, getting the information, that's what drags these engagements out. And so again, I mean, I think when you coming to the table as a seller and you can present to a buyer and say, listen, we already have this information packaged, that's going to allow this transaction to close quicker. That's what the buyer wants to hear, and hopefully that gets reflected in perhaps a little bit higher multiple, knowing that, hey, yeah, this stuff is all presented in a nice clean package, so we can close on it quickly. And so, sure, is that worth another multiple to us in the negotiation? It could be.
Sometimes that delay, which you say is, well, the seller isn't really, prepared, for all the questions. Of course not, because if the buyer wants to know the blood type of every employee, it's going to take a long time to get that information. Is it necessary? For sure, it's not. That's the problem. So to answer my own question, if this thing is lasting more than 60 days, 90 days, there's a real problem here. I'm not sure what it is, whether the seller doesn't really want to sell, whether the buyer really isn't going to buy, or I don't know what they're waiting for. It shouldn't take that long to do a transaction unless the parties have in advance said, you know what, I don't want to sell until January. I don't want to sell until, I want to sell before December. If that's different. Let me get to some of these questions because I don't want to run out of time before we get to them. Can you speak to the RMR variables related to the services? For example, with T&L, it requires personnel to visit the site at certain intervals. It's not a ton of hands-on for monitoring accounts. I guess they're asking the difference between monitoring service and inspection, of course.
Right.
The hosted services, such as managed, I'm having trouble reading this.
I think I know where this question is going. And so what's becoming the case more and more these days is it's not just like one revenue stream of alarm monitoring, right? So companies have multiple RMR streams. It can be, the example in that question was hosted access, test and inspection, could be service contracts, et cetera, et cetera. So one of the things that we try to do very early, and this is in the kind of almost pre-due diligence stage, this is in the LOI stage, is to sort of look at the different revenue RMR buckets that a company has. So we say to the buyer, that's the first thing we got to do is when we get the RMR, let's break it down. How much of this RMR is from service contracts? How much of this RMR is from test and inspection? How much of it is from video monitoring, managed access, on and on and on. And then what we do is we try to figure out the profit margin on each of those RMR streams. So the profit margin, as the question points out, for monitoring might be high, but on test and inspection might be a little low. On service might be zero. Right? So that's one of the important things, is to understand that all RMR is not equal.
Next question. Contracts seem to need to be updated every few years. Does an old contract have less value than a new contract that may contain newer languages? If the newer contract, if you have a newer contract, can you expect more RMR?
That sounds like a good question for you.
I think of course,
yeah.
Of course. But yeah. If you look, a written contract is better than no contract. We had an earlier question, which was withdrawn. What's the value of an unsigned contract? Well, obviously, it has no value. It's an account without a contract. Liability issues change from time to time. We've changed the exculpatory clause, limitation liability clause, indemnity clauses. Sometimes older contracts do become unenforceable because of their language, and so you need to be updating. From a buyer's point of view, look, you could get a buyer that forces you to agree to a indemnification provision, or reps and warranties rather, and indemnification, where you're representing that your contract is enforceable. I don't really want my clients to sign something like that. You don't know whether your contract's enforceable or not. We think it is, but why should you be making that representation? So if you have an older contract, you've got more of a chance that there's a problem with it than with a newer contract.
And I think one of the things that we see a lot is it's one thing to say, okay, you have a proper contract that's got up-to-date language, et cetera. You have it in place, it's signed, et cetera. But one of the things that we see a lot is the way that the contracts are filled out, right? We find inconsistencies, like the billing system says that they don't have a service plan, but that's checked on the contract, right? Or there's so many different variables on the contract where it says, is this service provided or not provided, provided or not provided? And they have to do a series of yeses or nos. And so just completing the contract properly is a whole additional. You can have a perfect contract form, but if you're not completing it properly, it still could possibly get thrown out of a deal or considered to be ineligible.
Well, how about a seller that tells his buyer, well, we're getting $40 a month for monitoring. Okay, great. And service, how's that done? Well, they pay us or this or that, but turns out that the service box is checked as well for that $40 a month. And plenty of customers think they're entitled to service. Maybe the seller's been giving it to them, maybe he hasn't. You need to know what you're selling, and you need to know what your contracts call for. It's also possible that contracts are filled out and then promptly ignored by both the alarm company and the customer. Maybe they're including service, maybe they're not. You need to make sure that the way the contract reads is the way you've been conducting your business. That's
right. So if you don't have to necessarily look at every single contract. If you have 1,000 customers, if you just do a sort of a self-survey and you look at 100 or 200, you'll know pretty quickly where your problems and deficiencies are, and then you can take it out to the rest of the contract base. So you can do it just a sample.
Could we please have copies of the last few slides? The entire presentation will be posted on the K&K website, so you'll be able to see the whole presentation, including all the slides that were presented. Does Jim's staff go to the site of the seller to do his due diligence, or does he require the seller to provide all of this info electronic? I'm sure he will go to the site for the right money. Maybe. I don't know.
Nowadays, we can get so much online, between, DocuSign and shared drives and things like that. So we can do a significant amount of the work remotely. And then, there's a piece of it that it helps to be on site. But nowadays, and we had to adapt to doing this during COVID, we do the vast majority of the work remotely.
Okay. How do you perform a lien/UCC check? Well, that might be considered proprietary information, but there are available ways to do that, and it needs to be done. So, if you're wondering, gee, can I do that myself and maybe save myself $100? Maybe. You could do a lot of things yourself, but you shouldn't. You should have professionals doing it for you. How does Jim structure his fees for his service to consider doing it annually? I guess they want to put you in a new business, Jim.
I think what we would do initially, we would have sort of a broad-reaching sort of scope of work, and then we would identify the items that need to be worked on, and then revisit that some period later to see to what extent were those deficiencies remedied. Right. So I think it's more like a follow-up checkup would be much less involved because we already have the baseline to start from.
How many years of RMR should you present to the buyer? For example, the past 2 years or 5 years of RMR?
I'm not sure exactly what it means by the question. Maybe that means sort of like what the RMR history has been. Has it gone up or down or something?
That's what it's asking you.
Yeah, that's We typically, when we're looking at attrition, when we're looking at pay histories, when we're looking at signal histories, we like to do a 2-year time frame. So certainly more is fine, but we want to see at least 2 years.
See, that gets back to what I was suggesting before. What do you do with a buyer who tells you he wants to do due diligence and he needs to see 15 years worth of RMR? You tell them take a hike, basically, because you're not putting it together. You tell them, I'll give you 2, because that's what Jim Wooster says is reasonable. Okay. If a contract has reached the end of its original term and then renews automatically per the contract language, is that contract valued less than one in original term? The answer to that is no, because contracts are generally blended in a deal. Now, if you have 1,000 accounts, every single one of them in original term, or every single one of them in auto monthly renewal, then you're going to see perhaps a change in the multiple. If you are in a state that requires some form of notice on automatic renewal, and you're not complying with automatic renewal notices, then you can expect a much greater reduction in purchase price. You might even expect to have those accounts excluded altogether, or covered by your representation and warranty that your contract's enforceable, when you and the buyer both know it's not, because you haven't complied with automatic renewal. Same goes for that 3-day notice of cancellation. It's in there. If you haven't been complying with it, all of your residential contracts are at risk, and a buyer knows it, and he's going to take that into consideration, and it might be or might not be covered by reps and warranties. If you have a contract that states 36 months, do you need to have the customer sign a new one every 3 years? No, you need to have an automatic renewal provision in your contract. If you raise your price, do you need to get another contract signed with the new price? Not if you have the standard form contract offered by my office, because we have an automatic update option of 9% per year that the customer agrees to pay. The otherwise, yes, you cannot raise your price without the consent of the customer, and doing so might actually breach your agreement. Okay, so that's another reason you should be using the standardized forms. Jim needs to send out a general price list to us. He just did. 5,000 to 7,500. Tell him you saw the webinar. I'll authorize a 5% discount. Jim, do you do lease financing for commercial accounts?
Yeah, I'm happy to take that discussion offline if you want to talk to me. It's a pretty lengthy discussion. There's a difference between using a third-party leasing company versus kind of becoming your own leasing company, and there's pros and cons to either of that. But we do provide lines of credits to businesses in order for them to offer leases to their commercial customers.
Yeah, I think that's another webinar that we have to do. In my opinion, cautioning alarm companies from using third-party leasing operations. I'm in favor of leasing, of the company self-leasing, and using a company like Jim's company for financing those leases if it has to. Generally, that financing then is provided to the alarm company, not the customer, whereas third-party, it's provided to the customer and usually guaranteed by the alarm company. Sometimes it's not a recourse. We are interested in buying RMR, techs too. You can't buy a tech. You have to buy a company. And we have new contracts. Good, you're on your way. Give me and Jim a call. What electronic means are lenders accepting? DocuSign is the vaulting provided by eOriginal necessary. So this is a question of what contracts are you seeing out there? A lot of times it's not paper with original signatures on it. I
Yeah.
think they're fine. Electronic contracts are fine from a legal standpoint, but Jim may have a different perspective on it.
Yeah, this is again a whole big topic. Real quickly, the enforceability it's obviously what Ken is saying, they're fine. That's not the question. They're just as enforceable. It's really what it comes down to is being able to demonstrate that that version is the one and only bona fide original version. And so e-originals provide some, electronic watermark, et cetera, that does that. However, we find buyers are perfectly comfortable with DocuSign when they get the receipt that is produced when the document is executed, where it's got the IP address and the date, and et cetera, on it. So again, that's my quick answer on that one. It's a whole topic.
There are other companies besides DocuSign, by the way. For example, my office, we use Adobe eSign, which I find acceptable. And you do get the history of the email when you send it out, when you get it back. I mean, what good is updated contracts if the company owner continues to allow cross-outs or changes? Well, obviously, you need to be careful what you cross out. And let me give a plug for our concierge program that Kirschenbaum & Kirschenbaum offers, which allows a half hour each month for free towards contract review and negotiation. If you're using the standardized contract forms, and even if you're not, you are getting challenges by your customers when they see those contracts and they're asked to sign them. You need to have these changes reviewed and approved by counsel. If you think you're experienced enough to do it on your own, you might be, but prudence would suggest that you have it looked at by me in particular, or a lawyer that can review these things. I'm not suggesting that you have a very strict policy of no change. That's not practical in a lot of these deals. So you have to know when you can make a change and when you can't make a change. Obviously, if you're changing the term from 60 months to 36 months, you can do it. If you're changing, you're going to provide service 24/7, as long as you understand what that means, that you can do that too. But and if you're changing the limitation of liability from 250 to 1,000, you obviously know what that means too. But when you're tweaking the exculpatory clause or the limitation of liability, or you're eliminating indemnity, or you're eliminating insurance procurement, you need to know what you are retaining in that contract that will offer you enough protection to protect yourself if you're sued, enough protection to protect a buyer who buys those contracts and then inherits those customers.
When we get paid to do due diligence on behalf of a buyer, that's what they're paying us to go find. They want us to root out all of those things, and then they get tossed out of the deal.
Here's the question. We currently do not track attrition, although could go back and identify lost customers. What would be some of the metrics here to capture? And the next question is what is the average attrition number for a mid-sized company?
So the first item, we can go back, even if you're not tracking attrition, and get information on adds and deletes from the central station. So that's fairly straightforward to kind of reconstruct the attrition. As far as what the rate goes, or what the rates go, it's all over the board. We've got clients we work with 4% attrition and those with 14% attrition.
Well, that's a good range, and it's a wide range. So in other words, if you're under 4, you're doing really good, and if you're over 14, you're not doing so good. That's for sure. Okay.
I mean, single digits is certainly what I think buyers would love to see.
It depends on the operation. Also, it's really crazy in a way. Some alarm companies are out there and you ask them how many deals do you close each month, and they'll tell you 10, 20, so 5. That's how many new customers they're putting on. But you could have a company that's putting on 500. Now they're gonna be losing. That they may have a much higher attrition rate in that kind of an operation.
Yeah. And so when we're looking at it strictly as a lender, right, we're just going to lend money to this company. We do take that into account. And if they do have a higher attrition, but they are adding more accounts each month, and so their net growth is positive, then that's okay for us as a lender. But the buyer is going to ask themselves, okay, fine, you're putting on a lot of accounts, but when I buy your accounts, does that mean I'm going to instantly be getting a lot of accounts? That benefit may not transfer to the buyer.
Yeah, I want to just go with 2 more questions that we have, because we really went over. With very clean due diligence, do you see multiples normally calculated the gross RMR or net RMR? I don't care how clean your company is. You're always going to do net RMR. But what I didn't tell you is, what does net RMR mean? Okay, I'm not going to tell you what it means, but net RMR has to be defined. But for sure, you're not selling on gross RMR. You're selling on gross RMR. It doesn't make sense. Is it possible to get a copy of the webinar? It's going to be on Kirschenbaum and Kirschenbaum's website. All our webinars are there. Please give us a few days to post it. And one last comment here: companies that use USA, or that's USA Central Station, or Stages, which is a operating a platform, I think, software monitoring platform. There is a report in the dealer portal to track attrition. It's it looks to be a 2-minute report. I think he's writing. So you could be tracking attrition, and that's an important issue. Look, obviously you want to know how many customers you're retaining or losing, and perhaps more importantly, you want to know why you're losing your customers. That might be a more important issue to you than how many you're losing. There could be a good explanation for why you lose a customer, but if it's because your receptionist was rude to them, or your central station was rude to them, or you haven't been to their house in 10 years and their system barely works, I mean, these are things that you probably should be looking at. Okay, you know what? We've run out of questions, and we've more than run out of time. And I want to thank Jim. I want to thank all of you for attending. I hope you learned something. I hope you avail yourself of Jim's new service. It's one that's sorely needed in the industry, and you should definitely take advantage of it. Okay. I know I like to take advantage of them, so will you guys should also. Okay. So with that, I'm going to say bye-bye and thanks to everybody.
Thank you, Ken.